What up, guys? So I want to talk today about how you can really up your trading game by understanding how professional gamblers think. And I don't think people realize how tight the correlations are between trading and gambling. For example, one of the most legendary traders of all time, Blair Hull, who bought the bottom in the 1987 Black Monday crash, he started out as a blackjack card counter. He came up with his own card counting system, and he was a math teacher in California. He flew to Vegas, just grinded the blackjack tables and ran up his bankroll to over 30 grand. And then he took that money and parlayed it into his trading business, Hull Trading. And he came up with basically a rough estimate of the Black-Scholes formula. And his formula was like way faster to calculate. And it was okay that it was a rough estimate because the markets were so wide at that time and no one knew better. So he was just printing money with his whole trading firm. And he hired all these people, and eventually he got acquired by Goldman Sachs for $500 million. And since then he's parlayed that money into other ventures. And he even ran for Senate against Barack Obama, but they used some like underhanded tactics, damaged his reputation or something. But anyways, no, it's crazy. I used to work with this guy, like not directly with him, but I used to like pee next to him in the urinal next to him, because he was on my floor in the Board of Trade building. It was weird, peeing next to someone who's a billionaire. But anyways, yeah, even the founder and CEO of the first trading firm I worked for in Chicago, he was the president of his fraternity, and he would tell these stories about how he started a casino in his basement and how it made all this money and how it sort of taught him all these lessons for starting his own trading firm as well. Because in both setups, he's basically saying he wants to always be the house. He wants to always be 55% or better to win. A lot of these guys who get really into trading, they come from a gambling background. And you see the correlations elsewhere too, right? Like a lot of trading firms, they're involved in sports betting now. So they have like sports betting trade desks now. Places like Susquehanna, they ask you poker questions in the interviews. Once you start there, they even train you through poker. You might play some poker games with them in order to learn about risk management and things like that. And they hire World Series of Poker bracelet winners to run their trade desks, like Bill Chen, and there's one other guy. So yeah, the correlations, they run deep. And so let's get into the lessons. So risk management, this is one of the most important aspects of both gambling and trading. In trading, you have things like the Sharpe ratio, where you measure risk versus reward when deciding whether to move forward with a trading strategy. And you do the same thing in things like poker, where if you can extract a certain amount of money from an opponent and you can do it while risking less money, you would rather do that. Any good player knows and understands that. And there's other things like position sizing, bet sizing. You want to decide how much to bet based on the amount of capital you have, because you don't want to be underutilizing your capital, nor do you want to be overutilizing your capital, because you risk blowout. So, in trading, they have this thing called the Kelly criteria, or the Kelly position sizing, which is a way to optimize for the size of the positions you put on when you make trades based on the bankroll that you have available to you. But there are other concepts like minimizing drawdowns and when to cut your losses. These are also concepts that apply to both. The next point is decision-making under uncertainty. These are games of incomplete information and randomness. And so a lot of people can't see the signal through the noise, but you have to be able to read the situation. So in the poker table, there's a concept called tells, where you can read the strength of opponents' hands through their behaviors. And there's this book, Mike Carroll's Book of Tells, where it goes through all these common tells. Like people will get really still when they're bluffing and they don't want you to read that they're weak, so they'll just get like really frozen, and their mouth might get dry, so they'll have to like drink water. And so there's all these little tells that people have, and people in trading have tells too. So especially when you're involved in market making, you get these broker calls, and brokers aren't allowed to tell you who the counterparty is, but there are tells. They'll act a certain way when there's a certain kind of counterparty, and then you'll know, oh, this is Goldman Sachs, or this is PIMCO. There are ways to sniff things like that out. And then there's betting patterns. In poker, people have certain betting patterns, like, oh, this guy, he loves to triple barrel once he feels like he's getting pushed around, or, oh, this guy, he'll bet big, but then he'll fold to a re-raise. And people in trading have betting patterns too. They'll bet like a certain size. They'll always buy a certain strangle or straddle one time a month, or They'll always come in and do 1,000 lots every Friday, and they'll do them back to back. They'll have 5 orders in a row. And so you know roughly who is who, and you know roughly what they're going to do based on these betting patterns. The next point is emotional discipline. Very important. In poker, in other aspects of gambling, it's called tilting. You know, you're running bad, you lose a lot of hands in a row, and you're getting heated, and then you start tilting. So you just start like playing really bad and emotionally just to, you know, increase the variance and try to like swing back into the positive because you want to just make your money back quickly. And so you're just exposing yourself to variance. And people do this in other table games and other parts of the casino too. And frankly, that's what the casino's counting on. As evil as it sounds, the casino's hoping that you start tilting so that you just start acting reckless, and then they get all your money. And so in the trading firm, it's, you might call it, you know, chasing your losses, or, you know, people have names for this kind of thing. But basically when you make trades and then you get unlucky multiple times in a row, you might start getting really emotional. You know, you might start just trading bigger and bigger to essentially double down and try to get lucky and have things swing back in your favor. This is why owners of trading firms will hover around trade desks and try to feel things out, because they want to make sure that people aren't tilting and acting really reckless. You know, that's very dangerous for an owner of a trading firm, because you can lose a lot of money very quickly if you just like lose your temper, right? So in both games, you have to have like strong emotional discipline, and you just have to follow a system and say it's okay, it was inevitable. The longer I traded, eventually I was going to get really unlucky at some point, and this is that time. I can't be emotional, I just have to keep following my system. Strategic thinking. You have to play the long game in both gambling and trading. You know, if you think short term, there's just going to be too much variance and it's hard to like separate the signal from the noise. But once you see long term and you back test things, you realize, oh, okay, this has a plus EV to it. I need to just stick to this system. But you still also have to be adaptable. So the market environment's always evolving. And so you have to be able to tune those knobs and levers if the situation's evolving underneath your feet. Lastly, you have to be able to exploit opponents when you see them. So at the poker table, you know, they'll call them donkeys or something, or whales. I guess they have all these cute animal names for these characters. But, you know, just some rich dude who sits down drunk and just starts splashing around and going all in every other hand. Like that's the perfect opponent that you want to target in on at the poker table, and you want to try to isolate hands so you end up playing one-on-one against that guy, because you know that they're reckless and you have an idea of how they play. And so the more hands you get involved with them, the more likely you can take their money. The same concept applies to trading. You know, you have these whales in trading, and they just come splash around in the markets, and they trade very inefficiently, and they're very predictable in what they're doing. So you can kind of just be this like lean shark that swims around them and chews a little bit of their blubber every now and then, and, you know, just takes their money here and there every day. And that's what a lot of trading strategies on Wall Street are about. It's just about finding these whales and just scraping money off of them every day. And so, yeah, that concept applies to both as well. All right, well, that's all I got. So if you have any other questions, just leave me some comments. Take care.